Good day and welcome to this risk readiness webinar. My name is Carly Edmondson and I am the Senior Product Manager of Business Solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of the Credit Trends in Commercial Lending Credit Risk Navigator presented by Tom Cronin and Jeremy Kelson from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many of your questions as we can at the end of the presentation. With that, I'd like to turn it over to Tom Cronin from AFS. Thanks for joining us today, Tom.
Thanks, Carly. Pardon me, and welcome to everyone to our annual review today. You'll be seeing many of the life of the service trend charts that are standard on these webcasts, but as today's focus is year-end data, we'll be presenting a number of December 21 versus December 20 comparisons. And we have some interesting results to show, so let's jump right in. So today, the data is coming from the RMA Credit Risk Navigator, powered by AFS. This monthly database enables data to be seen by segments such as size, geography, etc. There's $1 trillion in committed exposure. And right now we have about 850,000 individual loans, pardon me, and we've just signed a new customer and we're anticipating that that number is going to go up to 1 million. So you'll be looking at 1 million loans and over $1 trillion in exposure. The Credit Risk Navigator is newly redesigned. And here's a picture of the dashboard that we're using. This is our early warning problem loan management webpage. As you can see, it's very visual, very easy to move about, gives you the ability to look at data down to levels such as the 6-digit NAICS or an MSA or CBSA level. And again, this is refreshed monthly and the data goes back to 2003. And you're going to see a number of charts today that go back that far. So we're going to start with the commercial and industrial or C&I review. And just a quick definition. C&I loans are business purpose loans to companies with sales usually north of $1 million. These are manually underwritten and risk rated, and loans that are collateralized by owner-occupied real estate are usually included, or actually are included here in C&I. The investor-owned property comes later in CRE. So on this slide, we present the percent non-accruing, the dark blue line, 30 to 59 days past due, the green line, 60 to 89 days past due, the gray line, and then 90 plus days past due, the, let's call it gold line. And starting on the far left, 3Q03, and moving to the right, you see the impact of the recession starting in late 2008, then the recovery through 2015, another uptick primarily in non-accruing as a result of the energy crisis in the 16-17, and now the reaction to the pandemic that actually started in our data in April of 2020. And we're going to look at both the short-term past dues and the non-accruing in more detail on the next few slides. But I wanted to highlight the percent non-accruing for December 2021 before we move on. The ratio for non-accruing now for December 2021 stands at 0.62%. And if you come back, if you try to follow it, come back to the left, you see that this is the lowest non-accruals have been since December of 2007. So pre-recession levels is where we're at now. And this is all in this improvement, as you can see, is all in the face of supply chain issues, persistent inflation, and an increase in COVID-19 hospitalizations. So dramatic improvement, almost historical, near historical levels, historical best levels, despite all the other problems that we've been having. So here we're looking at the 30 to 59 days past due levels for the past year. And I'm going to focus just on the short-term delinquency because the 60 to 89, the 90 plus tend to not move very much. And the volatility that we've seen, that you see for this time period, is representative of what we've seen with short-term delinquencies throughout the life of the service. These values move up and down sharply over time. And you really need to look at the movement over a long period of time, not just month to month, to see what's happening. So for that reason, we've drawn the dotted line trend line. And you can see that this trend for the past dues over the past year shows an overall increase. And on the next page, we'll take a deeper look at what went up, especially in relation to the fact that non-accruals went down, but past dues are going up. So on this chart, we had the 30 to 59 days past due for each NAICS code for December 2020 in the dark blue and December 2021 in the green. And there's a lot of movement, but the most noticeable is for 55 management of companies on the heading towards the right side. Last year, past dues for 55 management were 0.41%. This year, the level is just above 3.3%. And while not as large, we also see significant increases for 22 utilities, back to the left, and then 52 finance, more towards the center. On the flip side, there's a group of industries that shows significant improvement this year, notably 21 mining, oil, and gas, 45 retail, and within retail, the improvement was for department stores, or what's called general merchandise, and 48 transportation. And within that, it was buses and airlines, industries that we've mentioned before were negatively impacted by COVID. So let's leave delinquencies and move on to looking at the non-accruals, a more current trend on non-accruals. And here we're looking at the non-accrual levels over the past year in the dark blue, coupled with the US unemployment rate in the gold. And you can see that these two basically move hand in hand. And the improvement that started in the last months of 2020 for the non-accruals has accelerated. And we've dropped from 0.95% at the end of March 2020 to just 0.62% as of December 2021. And we've dropped 24 basis points alone in the fourth quarter. So let's take a deeper look at what actually dropped. So similar to what we did with the past dues, here we take the non-accrual level for each NAICS code as of December 20 and compare that to the non-accrual level as of December 21. The most noticeable improvement is for 21 mining, oil, and gas. It's gone from a little over 7% to just a little over 2% over the same time period, as the barrel of crude has risen from $48 to $76. So those two were definitely tied together. So as the price of crude has gone up, the non-accruals have come down. Other industries with a big improvement were 45 retail, 51 information, and within information was actually the motion picture industry, and again, 55 management. You'll also notice declines or improvements for two industries that have been severely impacted by the pandemic, and those are 71 arts and 72 accommodation. But I'll mention that within 71 and 72, the improvement is not universal through the subsectors or the NAICS codes that are below that. There are many subsectors that improved, but there are many subsectors within 71 and 72 that have actually gotten worse. And we're going to focus on those next month, take a little deeper look and see within those what's improving and what's not improving. But for this month, we want to take a look at just two other sectors, And the first one is going to be the agricultural sector, where we saw a big jump in non-accruals. Before we get to this, I did want to mention, though, that there's another increase. Another increase that we wanted to mention was for 33 manufacturing, specifically within 33. Matter of fact, let me go back. So you see here 33 manufacturing went up. We're seeing increases in the every three-digit make center sector within 33. In particular, the big jumps for 337, which is furniture, and 336, which is transportation. And now 337 furniture doesn't have significant balances compared to other sectors. It's kind of a small sector. But what's there is up to 4.05% non-accruing. And most of this is for office furniture. Now 336, the transportation is much bigger than 337 and has an overall non-accruing rate of 2.5%, with aircraft parts being the highest. So now I'll move on to agriculture. And the non-accrual rate for ag went from 1.59% to 2.66%. And we thought it'd be worthwhile to drop down a level or two and see which subsectors here actually deteriorated. So within ag, forestry, fishing, and support activities have very low balances. Even so they improved, but it really didn't make an impact on the overall numbers. So let's focus on the two larger subsectors, crop and animal production. As of last year, crop was twice as bad as the animal production. This year, crop increased almost 100 basis points to 3.04%, but animal production has jumped almost 3 times and is now just about equal in the percent non-accrual to the crop. And within these, within crop, tobacco and potatoes are the worst, but again, the balances aren't particularly large. A subsector with a more substantial portfolio and declining in performance is tree nut farming, and with most of that for small loans, less than $500,000 to growers in California. Now within animal, the biggest subsector is cattle, and that actually improved. But the second largest subsector is poultry and egg production, and the non-accrual there jumped up into the double-digit area, leading most of that rise in the green that you see. So let's look at an industry where the non-accruals actually went down. And what we want to look at here is 21 mining, oil, and gas, which made a dramatic improvement. And if you've been with us for the last year and a half, you would have known and seen that almost every time we mention non-accruals for C&I, oil and gas is the leader by far and away. That looks like it's changing. All 3 subsectors here have improved by at least 50%. Extraction went from almost 6, it's now down to 1.8. Mining itself, and this is coal and other metals, went from 4 to 0.9. And support activities such as drilling improved substantially from above 16, almost 17, to just about 6%. Still high, but some dramatic improvements, and most definitely related to the rise in oil prices. And I just noticed in a couple of bank quarterly reports, a couple of them said that the outlook for lending in the oil and gas is favorable, and they expect that this will, the lending will begin to increase here as the credit quality and the performance improves. So Carly, I think we have a poll question.
So this poll is, how would you compare your bank's overall credit riskiness to your peers? It's more risky, less risky, same risk, or you're not sure. We'll give everyone another 30 seconds or so to respond, and then can end and show you guys the results. Okay. Still have a few people coming in. Okay, so we can share the results here. So it looks like definitely the vast majority put less risky. I think that's reasonably unsurprising, with 4% saying more risky, 57% less risky, 28% same risk, and 11% not sure. So this is definitely shows that I think that the overall perception is that it's usually people have less risky portfolios.
Okay. So let's take a look at the risk and the credit quality. It's interesting that 3 out of 4 people say I have the same risk or less risk. And one of the things you can do with the Credit Risk Navigator, and maybe I'll try to do that next time, is actually see, is your portfolio as risky or less risky than everybody else's in the group? That's always an interesting experience. So this is our criticized loan trends. And when a bank joins the Credit Risk Navigator, we map their borrower risk ratings to the RMA 10-point scale. And on that scale, borrowers rated 1 through 6 are designated as pass. 7 through 10 are designated as criticized with the following descriptions. 7 is special mention, 8 is substandard, 9 is doubtful, and 10 is loss. And so on this chart, we show the trend for each of these 4 categories or descriptions over the life of the service. And you'll immediately notice that this chart looks very similar to the non-accrual line on our first chart. What we have found over time is that criticized and non-accrual levels tend to mirror each other. Now, more recently, we reached a pandemic high of 8.6% in September of 2020. Since that time, we have slowly improved, dropping the overall percentage for 15 straight months now. And the overall percent criticized rate sits at 5.75%. Now, most of this is due to a drop in special mentions, the dark blue. And we know from the work we did with CCAR, with a lot of you who are on the line, that 7 special mention is a temporary rating. Borrowers do not stay 7s for long. And it's very apparent that the initial unknown of the pandemic, if you think back to almost 2 years ago now, caused that initial feeling of not sure what was going to happen, caused many borrowers to be tagged as special mention. And now, almost 2 years later, the banks that are on the service or within the service and with us today have a really good idea of who's going to be okay and who's not. And so a lot of these special mentions are being worked out and moved back into the past categories. So here we're taking a look again at the change from December of 2020 versus December of 2021, this time for criticized by the 2-digit NAICS code. And only 4, again, very similar to what we saw with non-accruals, only 4 of the 24 industry sectors had an increase in their percent criticized. Those 4 are 22 utilities, and that particular increase was due primarily to a large loan to a nuclear electric power generating company in Florida. 23 construction right next to it. And that's specialty contractors such as precast concrete and HVAC. This particular increase, though, is due more towards balances being down than actual criticized loans going up. 55 management is up, and 56 admin, and in particular in there, the facility support. And many sectors saw substantial drops here, most notably, again, similar to what we saw with non-accruals, 21 mining, oil, and gas, as the improved performance has led to an improvement in the credit quality. All right, so Carly, I think we have another poll.
Yes. So as you've seen, commercial loan growth in December was the strongest we've seen since the pandemic began. While end of period balances can be volatile, several underlying components bode well for the 2022 growth outlook. So our question is, for 2022 commercial loan growth, is your bank forecasting low single digit growth, mid single digit growth, high single digit growth, or double digit commercial loan growth? So we'll give everybody about a minute to respond and then show you the results. Still have a few people coming in. So another 15 minutes or so, 15 seconds or so. Okay, so looks like it really runs the gamut actually, with the majority saying mid-single digit growth, but otherwise it looks like it's pretty spread out relatively evenly between all of the different options. So looks like the general story though is definitely growth. And back to you, Tom.
Okay, so let's go look at what the growth was this past year and see. We'll keep in mind what people are saying about 2022. If I remember, I will write that down, and a year from now when we get back together again, we'll see who was right and who was wrong. So what we're looking at now is the change in outstandings for C&I and CRE. C&I in the dark blue, CRE in the gold. And we're going to cover CRE later. You'll see the same thing in CRE. So let's talk about the C&I results right now. And the percentage changes are month to month. So the 4.52% you see in the upper right corner for December 2021 means that the December 21 balances are up 4.5% when compared to November of 2021. And for most of the year, growth or change in balances has been rather lackluster. And this, despite improvements in performance and credit quality, the demand for loans just wasn't there. People just weren't borrowing. And then in December, borrowers came back. And we've heard a number of reasons as to why they're coming back. Some of them seem to be very particular to individual borrowers, but the overall impression was that the feeling amongst the borrowers, amongst your borrowers, was that 2022 was going to be a much better year, and people were beginning to stock up on inventory to get a jump on what's coming. So what we've done here is looked at the outstandings for each NAICS as of December 2021 and compared that to the outstandings as of December 2020, a little different from the previous chart. So the actual calculation is December 21 minus December 20 divided by December 20 to give us the percent. And once again, we see most of the industry sectors moving in the same direction. 20 of the 24 had a positive change in outstandings, led by 52 finance, which is funds, trust, and other financial vehicles, 23 construction, and within there's money for highway and bridge contractors, as well as electrical and again HVAC contractors. And then the third highest was 51 information, and within there that's telecom and software publishing companies. But all in all, very positive. What is it, 6 or so industries, 7 industries at 10% or above. Again, a lot of that in the last month, but very positive compared year over year. So now we're going to switch to CRE. And a quick definition. We define CRE loans as borrowers that meet the regulators' requirements, where the majority of the repayment comes from the rental or leasing of a property, such as an office building or a warehouse. And typically, these are referred to as investor-owned properties. So here's the performance trend numbers for the CRE portfolio. Again, percent non-accruing, the dark blue, 30 to 59 days in the green, 60 to 89 days in the gray, and the gold is the 90+ days past due. And you can see we started in 2010 with CRE, and going left to right, what you're seeing primarily is the post-recession recovery that led to non-accrual levels below 1% by 2015, and short-term past dues below 0.5% around the same time. But moving to the most recent results, CRE was a little slower to react to the pandemic versus C&I, but it was hit harder than C&I and has been a little slower to recover than C&I. So we have another measure in CRN called the performance indicator. And what the performance indicator does is it sums the values of these four measures that I'm showing you on the chart. And if you take that performance indicator for CRE, in December of 2020, the performance indicator for CRE was 2.1%. For C&I, it was 1.44%. Fast forward to this year, the performance indicator for CRE at December of 2021 has dropped to 158, but it is still above the C&I performance indicator of 1.26. So again, CRE came in, started later, but got hit harder and just hasn't quite recovered to the levels that we've seen with C&I. If you remember, particularly the non-accrual, the C&I non-accrual at 0.6 is pre-recession levels. We're still not there yet for CRE. So on this chart, we have the percent non-accruing for December 20 versus December 21 for the major property types. And when I say major, I mean the property types with the highest outstandings, the highest balances. And lodging continues to have the highest level of non-accruals. And to be honest, the change from December 20, the dark blue, to December 2021 in the green was not as much as I had anticipated, especially when you contrast this to the change that we saw with the individual NAICS codes in the C&I data. And I'm specifically, thinking of the dramatic improvement in oil and gas. I actually was expecting something similar for lodging, and it just doesn't seem to be getting better very fast. And I took a further look at this, and almost 100% of the lodging non-accruals are still located in either New York City or Boston. And several states do not have any lodging non-accruals. States such as Maryland, Virginia, Georgia, Colorado, and Michigan, states that you would think would have a lot of travel. It just seems that for some reason, the hotels in New York City and Boston are having a hard time recovering. We also continue to see very modest level of non-accrual for office properties, despite what I'm assuming almost all of us today listening from our home offices, and people not yet going back and maybe never going back to an office. One last thing kind of surprising to me was that we had increases in 3 property types. There were slight increases, for multifamily and retail. And again, not trying to pick on New York, but over half of the multifamily increases were for large loans in the state of New York. Now, not New York City, other states outside of New York, I guess you call central New York, had increases for multifamily non-accrual. Almost the same thing for retail. About 50% of the non-accruals are in New York, but this time it is New York City, which to me maybe goes hand in hand with the problems in lodging. You also see a big jump in mixed use, but the largest of this being in the District of Columbia area. So that's where New York gets off. I just thought it was strange that you're seeing so many problems in New York City with lodging, and it seems to be impacting some of the other areas as well, the other property types. Although I guess if you think about it, if nobody's traveling to New York City, nobody's going to be buying anything. So again, we have the criticized loan trend here for C&I. Again, it's just a reminder, it's based on the RMA 10-point scale. Borrowers 1 through 6 are pass, 7 is special mention, 8 substandard, 9 doubtful, 10 loss. And if you look left to right, you can see how we improved and dramatically improved. We were, and this is total criticized loans, around 2018, 2019, we're down around 3%. And then when the pandemic hit, we jumped and we got to 8.9% in July of 2020. Since that time, we've experienced a trend of steady improvement. There's a few bumps along the way, but overall we're improving. And for December of 2021, we're down to 6.76%. And here is criticized by property type. And I don't think this is really, I don't think you'll be surprised by any of this. Again, lodging is just, not only from a performance standpoint, but also from a credit standpoint or a credit quality standpoint, it is still just not there, has not come back at all. Some of the other industry or property types that are improving, healthcare, which a year ago, that was because of doctors' offices and doctors not being able to see patients. That's come way back down, very drastic improvement. A little bit of improvement in multifamily, a decent improvement for retail. The one other industry, actually the industry that we've seen the most increase is offices. And again, we talked about that earlier with people not returning to work in an office. The outlook for offices are probably not all that promising. So I said we'd come back to this chart when we were talking about C&I, and here we are, we're talking about CRE growth, or for better term, lack of CRE growth. And again, just to remind you, so where you see December of minus 44%, minus 0.44%, that's December's balance compared to November's balance. So December's balance is lower than November. And for 8 out of the 12 months this year, CRE outstandings have declined on a month-to-month basis, including the last 5 months straight. And since the early days of the pandemic, when construction projects were shut down due to health restrictions, CRE outstandings have basically been flat and have struggled basically to maintain their level. And at this pace, it doesn't look very promising for CRE growth. Let's take this is going to be our last chart. So we'll take a final look at what's growing in CRE. And Carly and I were talking about this just before we came on. The growth is in, all the growth is in 2 areas, residential. So these are homes being built. And we were talking about the prices of homes and how people are paying more than what they're listed for. And we're up around a 12% annual year-over-year increase in residential lending. Industrial is up also about 7%. And this is a bit of a change from what we had seen maybe over the last 2 years or so, where even though industrial properties were hot for the market in the general sense, banks didn't seem to be getting their share of this, but now it appears that they are. Every other property type, every other major property type has seen a decline year over year, particularly multifamilies, which are down well over a negative 10%. Some of this, from what I've heard from the bankers on the call, is due to projects being finished and just a hesitancy to lend again, and also problems that builders are having finding contractors or people to help build these properties. A lot of people not wanting to work or have gone on to do something different. So it's very hard to find people to work. So that's it for our December 2021 data. Just some quick recap. C&I percent non-accruing is at its lowest level in 14 years. It's lower than it was prior to the recession, or about the same as it was prior to the recession, which to me is very fascinating how dire we thought it was going to be 2 years ago and how it turned out to be really not much at all. Credit quality for C&I and CRE continues to improve, and loan growth for C&I jumped in December 2021. And I thought the poll results were very interesting, that most of you or at least half of you think you're going to be in high single digits to double digits. So that looks like this growth might continue. So that's it. And Carly, I'll turn it back to you for questions.
Great, thank you. We have a few questions on here. So the first one, Brooks really spoke to, I think, something that we noticed of the question about risk relative to other banks, and the idea that everyone's children are above average and the men are stronger. And so that's definitely a very interesting in comparison to what we hear from regulators. And but he also asked the question, I wonder if residential CRE is growing due to supply chain constraints where construction is taking longer while builders wait for material or contractors. Tom, do you have any kind of opinion or thought on that?
I don't have any solid or numerical reaction to that, or data to back that up or not. I don't. That's something I'll take a look at, Brooks. I'll see what I can find on that. That's a good question.
And we have another question from Dev. Tom, if you exclude lodging property type, would CRE total delinquency rates still be above C&I?
Dev, it would not. It would not. Lodging is really is skewing the results there, both for delinquency and obviously non-accruals as well.
So those are the only 3 questions we have right now. We can certainly stay on another minute if others have questions. So please feel free to submit any questions you may have that are additional. But in the meantime, I will say, if you were unable to join our live demo for the new user interface for Credit Risk Navigator, make sure to watch that on demand by visiting the rmahq.org website. We had a great conversation about the new platform and how you can use it in real-time scenarios. And so it looks like we don't have any other questions. In that case, thank you so much, Tom, for sharing your insights, and thank you to everyone for joining us today. We look forward to having you at our next session on credit trends. This concludes our webinar. Please take a moment at the conclusion of the event to complete the post-webinar survey. Thank you, and we will see you all next month.
Thank you.